Hi, I'm Ray Meadows, Prince of Finance, and with me is my friend Hiromi.
Hello.
So, as I explained in our video about money market mutual funds, it's a good place to start for people who don't want to take any risk or want to take absolutely minimal risk. But most people who are interested in investing want to get bigger returns than they can get from money market mutual funds because they pay very low interest. But yet, they are concerned about risk. You don't want to lose money, right?
Of course not.
Of course not. Well, unfortunately, you can't really do much investing without taking some risk that you could lose money. But sometimes the time period is important. So when I said money market mutual fund, the idea there is from one day to the next day, you're not going to lose money. Even if you put the money in today and you need it out tomorrow, chances are you're almost surely going to get your money back and maybe a little bit of interest. And so that's how I was thinking about no risk of losing money. But once you go beyond a day, things are a little bit different. So, for example, let's say that you're saving for a house. In 5 years, you want to have your money to buy a house. And so it doesn't really matter if the value of your account goes down tomorrow, because you don't need the money tomorrow, you need it in 5 years. So in that case, you could buy a 5-year government bond, right? So you buy the bond today, you put $1,000 into the bond, 5 years from now, you're going to get $1,000 back, plus maybe 1.3% interest, let's say. That's roughly what it is. Now, the thing is, tomorrow or the next day or next week or next month, the price in the market of that bond could go down. So, if you needed to sell at that moment, you would only get, say, $980 back. So, then you could lose money if you sold. But if you held the whole 5 years, you get your $1,000. The point of that is that the chance of losing money sort of depends on your level of impatience and how long you can hold and what kind of investment it is. And I can tell you from experience that people that look at their account every day, and if they're investing in stocks or something risky, they're going to see it going down a lot. It happens. It goes down, it goes up, it goes down, it goes up. And if you're looking at it every day and it makes you nervous, sooner or later, it's going to go down enough that you get really scared and you sell, and now you lost your money.
No.
That's a real loss. Versus if you could hold it for the whole 5 years, you would have made your money back, no problem. So the kind of person you are, in a way, determines what kind of investment you can buy and what time frame you need the money back. If you need it back soon, you shouldn't take much risk. Get that?
Yeah. Yeah.
So the key thing is, in deciding this, it's a little bit complicated because you got to look inside and go, how do I feel? How patient am I? How much risk can I take? Am I going to look at my account every day or not? And so I think people have to learn about themselves a little bit and learn about investing. And so what I recommend is you get some experience. So let's say you had $10,000. If you had $10,000 and you want to get some experience and learn how to invest in things other than money market mutual funds, I would take the $10,000 and I'd put $5,000 in a money market mutual fund, the very low risk thing. And then if you ever need it, it's there, and that'll give you some comfort. And then you take another $3,000 and you put it in a broad-based bond index fund. Like you could buy an ETF, exchange traded fund, ticker AGG. It's the Barclays Aggregate Bond Fund. Okay, that's very low risk. It's going to pay higher interest than your money market fund, and it might move around in price. And so get some experience with that. and then you have another 1,000. Actually, you should have put 2,000 in that, okay? Then you put another 1,000 in a high yield bond fund, and I'll give you a ticker, JNK, just to get some experience with that. That'll be more risky than the other one. So we're going down the levels to higher and higher risk, okay? The next one, another 1,000, you put it in S&P 500, which is large cap stocks. And then finally, one more 1,000 in the riskiest thing, which is small cap stocks. And that's, I think it's IWM, with Russell 2000. So if you did all that, then you would see, you know, the money market fund doesn't move around. AGG moves around a little, and it gives you a little bit of interest. And then the stock, SPY, and IWM, these things are moving a lot, and you might get nervous and sell them, but at least it's only 1,000 in there. So if you did all that, you get an idea of how do I feel when things move around, how do I feel when they go up, how do I feel when they go down, and you get a feel for how much money you can put into those things. Some people can put half their money in the stock market and it goes down 50%, and they're like, yeah, whatever. But most people will sell and take a loss. So better not to have too much money in stuff that you're gonna
High risk.
that is high risk, unless you're the kind of person who can just not open their account statements for 5 years. If you can do that, then you can take a lot of risk.
So with the high risk, right? So you said you can lose.
Yes, you can lose if it goes down and you sell.
And if I freak out and sell it.
Yes.
But if I don't freak out, just keep it. Just hold it.
Eventually it'll come back.
Just hold it for...
It might take 20 years, but eventually it'll come back.
Okay.
That's why time frame is important, right? If you're saving for retirement and it's 20 or 30 years, you can just put it in stocks and forget about it.
Can you really? Even with the high risk?
Sure, because eventually it's going to go up in 20 or 30 years if you can hold it. But most people can't do it.
Maybe like just let's say I have it for 20 years. That's good. Like I mean, like what am I trying to?
There's no.
I mean, like what am I trying to say? I don't know.
Well, there's no guarantee.
You said it's high risk, right?
Well, there's no guarantees in life, and it depends when you buy. So, for example, if you know, long time ago in 1999, there was a stock bubble in tech stocks.
Yes.
And if you bought a bunch of really expensive tech stocks at that time, you probably still haven't made your money back. So, depends when you buy and what price you pay. But if you get a really broad-based index and don't put all your money in, it's probably okay.
How come they didn't get it back?
They paid too high a price at the beginning.
It crashed.
It would be like, you know, house prices went up to 10 million each and you bought one. Once you get a lot of money, then you need to have an advisor to make sure you don't do that. But if you're only investing $10,000 and you've got 20 years to go, it's okay.
It's okay. Everything is okay.
Take a chance.
Okay.
But I would always recommend having some bonds and some stocks.
Not just one.
Not just all one thing.
Definitely not just all in high risk thing.
Yeah, diversify.
Don't do that. Yeah. Okay, sorry.
Okay. That's my advice for today.
Thank you for your advice.
Okay. Bye-bye.